All right, let's dive right in. Today, we're on a mission. We're going to crack open one of those super dense, jargon-filled documents to find out what's really going on inside. We're decoding the IPO for a company called Vikram Engineering. Let's do this.
So you see a new company hitting the stock market, right? The buzz is everywhere. And you start wondering, hey, should I get in on this? It's a really tempting thought. But before you can even begin to answer that, there's a huge first step you've got to take. And that step is learning how to read this, the company's official IPO prospectus. I know, it looks intimidating. We're talking hundreds of pages of dense legal text and financial tables. But trust me, it's the most important tool you have, and today we're going to use it as our treasure map. This thing is called a Red Herring Prospectus, or RHP for short. Now, here's the most important thing to get. This is not a sales brochure. It's not marketing. It's a legal disclosure. The company is required, by law, to tell you everything, the good, the bad, and yes, the ugly. Our job is to find all three, and we're going to start with the good stuff. Every RHP starts out with the company putting its absolute best foot forward. This is the highlight reel, It's the story they want every single investor to hear. It's their big elevator pitch, and it's all designed to get you excited about their business.
So, who is Vikram Engineering? Well, they're what's known in the industry as an EPC company. Basically, they're the people who design, buy the materials for, and then actually build massive, complex infrastructure projects. We're talking about the really critical stuff that a country runs on. High-voltage power lines, huge water supply systems, and railway electrification. They handle the whole shebang, from the initial blueprint all the way to flipping the final switch.
And here's the story they really want you to see. Just look at that revenue growth. It's undeniable. They went from just over 5,200 million rupees in fiscal 23 to more than 9,100 million just 2 years later. The message here is simple, and it's powerful. We are growing, and we are growing fast. This is the absolute core of their pitch. And to prove that growth isn't just a flash in the pan, they show you this, a massive order book of over 20,000 million rupees. Now, what this number means is that they have a ton of confirmed future projects already lined up. It's their way of telling investors, hey, that growth we just showed you, it's not a fluke. We have a long, healthy pipeline of work coming. All right, so we've heard the pitch. It's a growing company, they're in a super important sector, and they've got a huge pipeline of work. Sounds pretty good, right? So now let's look at the actual deal itself. What exactly are they offering investors, and what are they planning to do with all that money?
Okay, so an IPO like this usually has two main parts. First, you've got the fresh issue. This is where the company literally creates brand new shares and sells them to the public. The money from this goes straight into the company's bank account to fund its growth. But then there's the second part, an offer for sale. This is different. This is where an existing owner, in this case the founder, sells some of his own shares. That money goes directly to him, not to the company.
So why do they need the cash? Well, the company says it's for working capital, the money you need for day-to-day operations. But if you start digging into the risk factors section, you find this little gem. They admit that their growth has always been dependent on high working capital. This tells us it isn't just a one-time need for cash. It's a fundamental, maybe even challenging part of how their business works. And that's our first real clue that there's more to this story. All right, it's time to pop the hood and take a look at the engine. The shiny paint job looks great, but we all know the real story is always in the numbers. So let's run a quick financial health check and see what's really going on. And on the surface, things still look pretty solid. Just like the revenue, the profit after tax is also climbing up nicely. So the company isn't just making sales, they're actually making money from those sales. That's a huge checkmark in the good column. But then we come across a number that kind of makes you hit the brakes. Over 7,600 million rupees in total debt. Look, a profitable company is great, but a company with that much debt is also carrying a lot of risk. All of that borrowing costs money and interest, and that can really eat away at your future profits. And this brings us to one of the most important, absolutely crucial lessons in investing. I cannot stress this enough. Profit is not the same as cash. Profit is just an accounting idea. It's what you've earned on paper. But it doesn't mean that cold, hard cash has actually landed in your bank account yet. And this is why that difference is so incredibly important. Look at this number.
In fiscal year 2025, Vikram Engineering had a negative cash flow from its operations of almost 1,300 million rupees. Just let that sink in for a second. Even though they were profitable on paper, they actually spent more cash running the business than they brought in. This is a massive, critical discovery. Okay, so how does this all stack up against their competitors? This little table gives us some fantastic context. First, their profit margin is actually better than the industry average, which is pretty impressive. But on the flip side, their debt-to-equity ratio is also higher than average, which confirms they rely more on borrowing than their peers do. So what we have here is a classic mixed bag. The potential for higher reward, but it comes with a definite dose of higher risk. And now we've arrived at the most important part of our entire investigation. Buried deep, deep inside that RHP is the risk factor section. I like to call this the confession booth, because this is where the company is legally forced to tell you everything, and I mean everything, that could possibly go wrong. And sometimes you find a single sentence that just makes you stop dead in your tracks. I mean, just read that. This is a direct quote from their own document. A recommendation that one of their key clients, the Ministry of Railways, should ban them for 2 whole years. This is a giant flashing red light. So what in the world is going on here? Well, the document explains that this recommendation comes from an ongoing investigation by the CBI, India's top investigated agency, into allegations of illegal gratification. That's a legal term that's often used for bribery. Now remember, railways is one of their 3 key business areas. A 2-year ban could be a truly devastating blow to this company. And here's the kicker. That railway investigation isn't just some isolated problem. The RHP reveals a whole pattern of other issues. There are clear problems with cash management. A big chunk of their client payments are over 6 months late, which totally explains that negative cash flow we saw. There are operational problems too. They've delayed tax payments before, and a client recently hit them with a penalty for project delays. And maybe most telling of all, no independent bank has even checked out their plan for how they'll use the IPO money. So we've gone on quite a journey, haven't we? All the way from that shiny business pitch to the dark and dusty corners of the fine print. Look, the goal today was never to tell you whether you should invest or not. It was to show you how to do the investigation for yourself. So I'll leave you with this final thought. Now that you're armed with all this information, what questions would you ask next? Developing that critical instinct, well, that's what really makes you a smart investor. Thanks for joining me.